My testimony makes four main points. The first is that, as already been noted, foreign holdings of U.S. Treasury debt have been rising rapidly. Between 2003 and 2006, for example, such holdings rose by about 50%, and their increase accounted for almost 3/4 of total federal borrowing over that period. Such holdings now exceed $2 trillion and account for more than 40% of Treasury debt held by the public. Although the estimates are imperfect, the evidence suggests that East Asian countries are associated with a significant share of recent increases, and at the end of last year, such countries accounted for almost 2/3 of foreign holdings of Treasury securities. In addition, the increases have been disproportionately tied to foreign official activity rather than private investor activity. At the end of 2006, foreign central banks owned 66% of all federal debt held by foreign residents, which is up several percentage points from 2003. And such foreign official purchases account for roughly a little bit more than half of federal borrowing since 2003. My second point is that these increasing foreign holdings of U.S. government debt are related to a more fundamental issue, which is the nation's substantial current account deficit. This current account deficit must be financed by increasing liabilities to and assets held by foreign investors. In particular, the current account deficit expanded from under 2% of GDP in 1997, as shown in my first chart, to more than 6% last year. As a result of these ongoing current account deficits, the net international indebtedness of the United States, that is, how much U.S. investors own abroad minus how much foreigners own here, deteriorated from about 10% of GDP, which is shown in Figure 2, to about 20% in 2005. You see that decline that was occurring in the late 1990s and early 2000s. So why has the current account deficit increased? There are a variety of perspectives that can be brought to bear on that question, but one is to examine the difference between domestic investment and national saving. As Figure 3 shows, net domestic investment climbed steadily throughout the 1990s and then declined on balance in the early 2000s. On average, it has been about 7% of national income since 1990 and in the past 4 years. This net domestic investment must be financed either by net national saving or by increasing net foreign claims on U.S. assets. Since the late 1990s, it has been financed increasingly by foreign claims, as the rate of net national saving, also shown on this chart, has declined from an average of more than 4% in the 1990s to an average of about 1% in the past 4 years. In other words, from this perspective, the increase in the current account deficit that has occurred reflects the decline in net national saving that you can see on that chart. So the question then becomes, why has net national saving declined? And one can, in the next chart, break the decline in the rate of national saving into its components, in particular federal and private net saving rates. As you may be able to see from the chart, the decline in the federal net saving rate from 2000 to 2003 accounts for much of the decline in net national saving over that period. After 2003, however, the rate of net federal saving rose, primarily tied to increases in corporate income tax revenue, which I could discuss more during the question and answer period. But the net national saving rate was little changed because the net private saving rate fell. The bottom line is that the nation's rate of domestic investment of roughly 7% of income or so is possible given our low level of domestic saving only because the nation is running a significant current account deficit, and that in turn is possible only because foreign entities have been willing to invest significant sums in U.S. assets and securities, including U.S. Treasury securities. That observation leads me to my third point, which is that economists generally agree that the current account deficit is unsustainable because the nation's indebtedness to the rest of the world will grow faster than its income, and foreign investors will not continue to be willing to purchase U.S. claims indefinitely as their portfolios become more and more concentrated in such assets. Views differ on whether the adjustment will occur gradually or suddenly, but there is little disagreement that some sort of adjustment is inevitable. As the CBO has pointed out in a recent issue brief, the more likely scenario appears to be a gradual adjustment without severe short-term economic consequences, but a sudden adjustment remains a risk and possibly a growing one as the nation's net indebtedness rises. And that leads me to my final point, which is that policymakers can help facilitate the necessary reduction in the current account deficit and reduce the risk of a severe economic disruption in foreign financing by taking actions to raise the rate of national saving. Focusing on government saving may be particularly important in light of the economic and budgetary outlook in the United States over the next few decades, as Mr. Ryan highlighted. Figure 5 shows that most of the discussion that has surrounded our long-term fiscal challenge has been somewhat off. It's often described as being caused by aging in healthcare. It is primarily tied to the rate of growth in healthcare costs. In particular, if over the next 4 decades, healthcare costs per beneficiary grow at the same rate relative to income per capita as they did over the past 4 decades, Medicare and Medicaid will rise from 4.5% of the economy today to 20% of the economy by 2050, as the top line of that chart shows. The bottom line shows the pure effect of aging on those two programs, and I think you can see that there's some impact there, but that rise, the difference on the bottom dotted line between 2050 and today, is much smaller than the difference in 2050 between the bottom dotted line and the top solid line. In any case, reducing government dissaving, that is reducing the budget deficit both today and in the future, is perhaps one of the most reliable ways through which policymakers could boost national saving. Such national saving could also be increased through higher private saving, and my written testimony discusses some of the possible policy interventions that could produce that effect. However it is accomplished, higher national saving is fundamental to reducing the current account deficit, which in turn will reduce the rate at which the nation is increasing liabilities to and assets held by foreign investors, including Treasury securities. Thank you.